In this session, we are talking about a set of strategies that typically becomes relevant after the company reaches a certain level of maturity. And these strategies are international strategies. So at some point in the lifetime of the company, once the company grows, it might decide to look for markets outside the domestic market. And in this session, we will talk about reasons why the company might do so. Then we will talk about the actual strategies that the company can apply. And finally, we will talk about some of the pitfalls and some of the risks and challenges that come with internationalization. But before we do so, we will start with a definition. So international strategy is defined on the basis of the domestic market. So it's a strategy through which the firm sells its goods or services outside its domestic market. And the relevance of the domestic market is something that we will cover shortly in this session as well. Next, let's look at some of the reasons why a company might decide to internationalize. And the first reason is increased market size. So the company might at some point decide that the domestic market is getting too small or growth opportunities are limited. So international markets offer an opportunity to extend the reach to new customers, but it's also an opportunity to extend the product life cycle. Maybe in the domestic market, the product life cycle is coming to an end or is reaching a plateau. And the time lag in consumer behavior that we see, for example, between the US and then emerging markets, or between the European markets and emerging markets, is something that companies can take advantage of. Also, there might be areas where the specific product that a company is in is not yet available, and therefore there's unsatisfied demand in some countries that the company can leverage and therefore increase its market size. The second reason, and all of these are by importance and relevance based on research. So the second reason companies typically use to internationalize is return on investment. So big investments, for example, in plants, in R&D, in new products, they come with a certain fixed cost. And international markets, referring back to number one, the increased market size, give the opportunity to spread this fixed cost over a larger market and over larger output quantities. And therefore, there are higher returns on the investment if the products can be sold in a larger or in a global market. The third reasons, and you see all of these are somehow linked, are economies of scale. So with higher output comes a decrease in the unit cost, typically by increased capacity utilization of the existing facilities, and also the opportunity to integrate some of the operations on a global scale. Examples for this are Airbus, for example, where basically the production base is split across many countries and the parts are being brought together to Toulouse to assemble the final airplane. Or another example is, of course, Apple. I think on the back of the iPhone, it says designed in California, but produced or made in China. So Apple is a company that uses those economies of scale and the global operations and global cost advantages to its own advantage. Reason number 4 is a little bit different. That's learning. So companies sometimes decide to go outside of their home market to learn about new consumer trends, new opportunities, to learn about new evolving technologies in global markets and so on. So an example for this was the telecom sector in the early 2000s. So some European companies actually ventured outside of Europe, went to Japan and Korea. Very clear that they wouldn't have a chance to get a big market share in those countries, but they used the opportunity to be in those countries and to learn from the incumbents and from the consumers about new trends, and then bring those trends and those technologies to Europe. So learning is definitely an important factor when companies think about internationalization. Fifth, location advantages. So some locations have just lower cost. For example, lower labor cost, or maybe also lower cost for raw materials, easier access to raw materials. Sometimes companies internationalize because their supply base is there already, is international already, so they see the opportunity to follow their suppliers. And a big reason, as mentioned already, is also the access of to consumers in emerging markets especially. Next, briefly some trends in international and in the global market environment. And the trends are in two directions, actually. Let me start with the negative one, and it's marked here in red. There is something that we can observe which is called the liability of foreigners. Let me elaborate a little bit what that is. Liability of foreigners is defined as a set of costs that is associated with like certain issues, certain problems, certain challenges that come about when entering a foreign market. So what can those costs be? For example, when you enter a new country, you might be unfamiliar with the operating environment, and therefore you might incur additional costs that the local incumbents might not incur. Economic differences, cultural differences might play a role here, which might lead to some difficulties at the beginning and some losses or some, again, increased costs and increased difficulties that companies face. Administrative differences. For example, here we are talking about licenses or approvals, regulations that might exist in certain countries that new incoming companies are not familiar with, and therefore they have a disadvantage compared to incumbents. And also the challenges that come with coordinating over distances. Time difference being probably the smallest problem to solve, but also delays in decision making, delays in transport of goods from one country to the other, and so on. That is called a liability of foreigners, and that is something that we can observe is getting more and more challenging, especially as we see some nationalistic tendencies in some countries. And just referring to the trade war between China and the US that we saw a couple of years ago. So this is part of the liability of foreigners if you're a foreigner in another country. On the other side, we see a positive trend towards regionalization. An example here for this is the European Union, or it's the ASEAN Economic Community, or AEC. So there's an increased focus on the regional markets rather than just country-based markets. And that helps companies to expand outside of their domestic market. So we see these two trends kind of clashing with each other and definitely contradicting each other. If you would have asked me a couple of years ago, I would have said there's definitely a stronger trend towards regionalization. But over the last 3-4 years, you can see quite a strong trend, especially also with the COVID crisis, that the liability of foreigners still plays a role and is still an important factor for companies. So next, let me talk a little bit about the strategies that companies can apply when internationalizing. And I want to start with talking about international business level strategies. So specifically strategies for a single business focus. And let me start off with two propositions that I want to make here. The first one is, on an international level, the home country of production, so the original country where the company is from, is often the most important source of competitive advantage. Meaning, if your industry is strong in your home country, then you have a real opportunity to take this advantage and bring it to other countries. So that's the first proposition. The second proposition is, the stronger the position that you have in your home market, the better are the chances for success in international markets. So if you're already the market leader in your home country, then you have a better chance to be also the market leader in international markets. I should mention, though, that exceptions exist. And one exception that comes to my mind here is Yum Yum. Actually, Yum Yum is a producer of instant noodles here in Thailand. And in Thailand, definitely it is not the market leader. It's probably the number 2 or number 3 in the market, behind Mama, which is by far the more famous and more popular brand here in Thailand. But if you go to Europe, actually Yum Yum is the one that is mostly on the shelves. So in Europe, so in the international markets, Yum Yum is the predominant product. So there are some exceptions, but in general, the company that leads in the domestic market is typically also the leader in international markets. Now, when you think about international business level strategies, a good framework and a good way of thinking around those strategies is Michael Porter's competitiveness of nations. So these are factors that are relevant for having a competitive advantage internationally. And the first one is factors of production. So if the factors of production are in place, meaning qualified labor, for example, or raw materials that are available, if you have an advantage through these ones, then you probably have an advantage over your competitors overall. So meaning if in your home country there are strong factors of production that play towards that advantage, for example, for the automotive industry, a very strong engineering mindset and engineering knowledge in Germany, or in the chemicals industry also, like state-of-the-art chemical engineering capabilities, then once these companies internationalize, once Mercedes or BMW comes to international markets, then they will bring along these competitive factors, and it will give them a strong competitive position. The second is demand conditions. So think of the automotive industry in Germany, where you have like very strong customer demand or customer expectations towards a car. You have no speed limit on the roads, at least for now. And consumers just love their cars. And I can remember as a child, we made a big round with a bicycle around cars just to not scratch the car, because that was seen as a very big problem if you would do that. So there's very big a very big automotive culture in Germany, and therefore the German car makers, they have to meet those demands of the consumers and have to innovate on a permanent basis, and therefore they also bring these capabilities to international markets and take a leading position there. Related and supporting industries. So if you have in your home country those supporting industries, for example, for the watchmakers in Switzerland, all the supporting suppliers of these very small parts, and also the training and the education of the watchmakers is all concentrated in a small area around Geneva in Switzerland and the surrounding area. So it's a very strong strong focus on these things, and therefore also that helps when they go international. It gives them an advantage and an edge. And finally, the strategy, the structure, and the rivalry in the industry, which also fosters the growth. So think of the car industry in Germany again. Here you have like a very strong rivalry between BMW, Mercedes, Volkswagen, Porsche. They all fight for the leading position every year, and because of the very demanding customers, coming back to point number 2, they are forced to permanently innovate and be state-of-the-art in their technology and in what they bring to the car. And therefore that gives them a very strong position when they go into the international market. So meaning the more competitive your domestic market is, and if you are able to compete in a very competitive domestic market, then it makes it easier to go into international markets because you have an advantage there. And that's the big takeaway here as well. So companies that operate in very country-specific industries, so in industries that your country is well known for, they have a higher chance of succeeding in international markets as well. So that's business level strategies. Now let's talk about internationalization philosophies. So when companies internationalize, and this is maybe also quite relevant for corporate level strategies, what are the philosophies that they can use when they expand? And in this 2x2 matrix, you see the 2 axes. So on the x-axis, it's the pressures for local adaptation. What does it mean? how big is the pressure to really be considered as a local company or very well embedded locally? Is it high or low? And on the y-axis, you see the pressures for lower costs, so for more standardization and scale and cost optimization. And the three relevant strategies, 3+1, I should say, the three relevant strategies are a global strategy if you have high pressure on low cost and relatively low pressure or unimportance of being considered as local. Then the multi-domestic strategy, which is the opposite. So multi-domestic means you pretend basically to be local, or you try to be as local as possible in your approach, and you have almost no pressure or no intent to use global scale. And I have examples on this in a second. If a company faces both, so the need to be considered local and at the same time also the pressure to have lower costs and use the scale, then that's called a transnational strategy. Let me say upfront that this is very difficult to do because these two typically contradict each other. But there are companies that have attempted this and have done quite well in doing so. There's one empty field, so there's another strategy which is simply called the international strategy. And you will see if you read the footnote here that these strategies were relevant maybe after World War II when companies really started to look outside their home country for the first time. Example here is Coca-Cola, for example, where companies went outside of their home country and they basically set up production bases or supply bases in each of the country without looking at really global scale. But these times where you don't need to focus on cost anymore are basically over. Yeah? And even though Coca-Cola didn't fundamentally change their strategy, but what changed for them is that they have much more power in terms of marketing and a much stronger brand, and therefore they basically moved to a global strategy because they used their brand strength to really bring down the cost for them. Now, let me give you the definitions quickly. So global strategy means that you use a standardized approach, standardized products across the markets. And often the competitive strategy here is dictated by the home office. Multi-domestic, again, the opposite, is the strategy where the decisions are decentralized. So you let each of the business units in each of the countries make the key decisions. And the home office, the original country where the company is from, basically has just a facilitating role. And then what that leads to is that brands and products are tailored to each of the markets. And then the third strategy, as I mentioned, transnational strategy, tries to achieve both the global efficiency and the local responsiveness. It is very difficult to do because these two are conflicting, as I already mentioned. Let me give you an example for each. The first example that came to my mind is Tesco. So Tesco is a company that uses an approach where basically in each country that they go to, and you see here Poland, Hungary, and the UK, for example, they use a standardized approach and leverage best practices. So what you see here, for example, is the packaging of their value line. You see the store design, including the decoration and everything, looks very similar. Actually, if you just look at the pictures here from afar and you don't read the advertisement slogans, you wouldn't know which country you are in just now. And even the signage, of course, they use the local currency with the pound, the forint, and the zloty, the local currency signs. But the idea, the concept is basically the same. So just leveraging the same ideas. So leveraging best practices across the globe, and those strategy, the signage, the campaigns, and so on, often being dictated by the home office. The complete opposite, and I stay within retail here, is Groupe Casino. So Groupe Casino is the company for Thai listeners that used to own Big C here in Thailand and also Big C in Vietnam. The group owns a portfolio of companies around the globe, and this is the current portfolio in the year 2021. They still have Argentina, Brazil, Cameroon in Africa, Colombia, and France, obviously their home market, and Uruguay. And you see that each of the brands is different, first of all. And if you would ask people in the country, if you go into the country and ask people about those brands, they would probably tell you that those brands are local brands. So Libertad is an Argentinian brand, Pão de Açúcar is a Brazilian brand, Casino is a French brand, and Disco is a brand from Uruguay. And same for Thailand. At that time, a few years back, if you would have asked people what Big C is, people would have probably told you that it's a Thai company, it's a Thai brand. So they intentionally try to be local, try to be considered as local. And in the back office, they still use certain policies and certain best practice sharing to really get some of the benefits of being a global company. But otherwise, the companies in each of the markets is fairly standalone and fairly free to make decisions. Now, finding an example for a transnational strategy is a little bit more challenging. But the one I found a couple of years ago is HSBC, so the bank. In 2003, 2004, they drove a campaign, a global campaign, where the slogan was HSBC, the world's local bank. And that's pretty much describing what a transnational strategy is. So trying to use the global scale and using local knowledge or positioning the company as a company that knows the local geography very well. And you see here some of the examples of how they try to portray themselves as being knowledgeable in different markets. And this was really a global campaign that was run in all the countries. So that's a transnational strategy. So next, let's talk a little bit about entry modes. So once a company decides to move into international markets, what are the options to enter the market? So the first entry mode and the most simple one is exporting. So once a company decides, I want to sell my goods in another market, I can find opportunities to export. It comes at a very low cost, but then also relatively low control. Especially if you don't have operations in the market, it's quite difficult to control and see how consumers react and so on. A next level of entry mode is licensing. That includes also franchising, for example. Basically finding a local partner and then giving the local partner a license to operate on your behalf. So this is something that, for example, beer companies do. They find local partners and they provide the recipe for the beer and allow the company to brew on their behalf. Same for Coca-Cola, for example, which uses local bottlers and gives them the license to bottle and basically fill the bottles and the cans and then sell the cans under the Coca-Cola brand. Now, this comes at quite low cost, also relatively low risk, but the challenge here is also little control. So companies like Coca-Cola or Heineken or Carlsberg and so on, when they use these strategies, they have relatively little control over what their bottlers do. And they need to put extra resources in place to make sure that the marketing and the quality and everything is to their standards. Otherwise, it's damaging to their brand. It gives you low returns, but again, it comes at a low cost. So it can be a very profitable model to do licensing. Then the next level of sophistication is strategic alliance. That includes joint ventures, for example, where you find a local partner and you jointly invest into the new venture. Of course, here you have shared costs. You share your resources as well. The risk is also shared. But finding a good partner, a trustworthy partner, is often a challenge. And then also the problem of the integration. So really, you have two different company cultures, country cultures, and company cultures that meet each other. So that can often be a challenge. One step further is acquisition. So that means you buy a company in the market that you want to enter. With an acquisition, you get very quick access to the new market. Well, the negotiations are often complex, and the whole strategy of acquisition usually comes at a higher cost. And you might still have problems with merging the domestic operations and the overseas operations. And as we discussed in one of the previous lectures, acquisition strategies often fail. So it's definitely challenging, but it gives you, of course, also immediate control over the business if you acquire the company. And finally, the highest level of complexity and sophistication is to have a new and fully owned, wholly owned subsidiary, which is also called a greenfield venture. So basically coming to a new country and building a complete new facility and entering basically from scratch. This is very complex. It can be costly and very time consuming to get familiar with the local regulations and acquire all the permits and so on to open the business. Comes at a higher risk, but it gives you also maximum control. So these are the 5 entry modes, and across these 5 entry modes, from number 1 to number 5, there's increasing complexity, but also increasing control. There is increasing risks as we move down, but also increasing returns. So all of these strategies are viable, but have to be assessed very carefully. One note here, typically there's something like a dynamic of entry modes. So meaning you start with exporting, you start with licensing, and as the business matures and as the market becomes more relevant, then you move down the hierarchy and down the level and increase the complexity maybe, but also the level of control. There are also examples, other examples. For example, Starbucks used to operate most of its markets and recently moved a step back and focuses only on core markets. And those markets that are not core, for them, they license it out. So there is some dynamics going back and forth depending on the strategy of the company. Now, having talked about the entry modes, finally, we need to talk about some of the risks that come along with international strategies. And there are 2 major types of risks. The first one is political risks. So obviously, if you enter a new geography, you need to be sure that the country is politically stable. There's a risk of war, military engagements, unknown outcomes, if there's local conflicts between different parties, if there's political protests or political instability, and that can all pose a security threat. So that is definitely something that companies need to monitor and need to be careful about when they invest money in a foreign market. Same as regulations. Regulations might change. There might be protectionist political trends. For example, the government might decide to ban foreign companies from doing certain activities or taking back some of the assets that foreign companies hold. So you always have to be aware that this is a risk that you are exposed to. And changes of law can always occur, again, like the nationalization of assets here as a main risk. Besides the political risk, there's also economic risks. So macroeconomic risks, for example, debt levels can play a role here. Prices can be volatile. There is risk of inflation. Currency risk is a second risk to be aware of. So especially if a market gains in importance, but then the currency fluctuates heavily. So that means also that the home country, that the total overall profits of the company fluctuate accordingly. So this is something also to be aware of and to manage carefully. Trade agreements might play a role. So sometimes advantages that you might have by being in the local country might go away if the country enters into a trade agreement with another country, and then the export and import of goods becomes basically without duty free, so free from any duties or any major trading costs, and that might change the economics of industries entirely. There's also the danger of counterfeit products and also the fight against counterfeit products. And then finally, we might have some financial risks. So we had the 2008 financial crisis that affected global markets, a credit crunch, and financial instability that comes with it. So there's something to watch out for. So that brings us to the end of this session. So internationalization strategy is definitely something to look at once a company reaches a certain level of maturity, and something that can help to expand the market and open up for new opportunities.